Zurich, November 2006. The S&P 500 is hitting record highs. The housing market is booming. The consensus among financial advisors is unanimous. The era of the Great Moderation is here to stay. Buy the dip. Stay invested. But inside a private wealth office in the city center, a senior banker makes a phone call. He tells his top 50 ultra-high net worth clients to sell their equities. Not 10%, not 20%. He instructs them to move 40% of their entire net worth into 3-month U.S. Treasury bills, yielding less than 4%. Boring. Safe. Unexciting. His clients push back. They think he has lost his edge. They think he is missing the rally. They fire him. 18 months later, Lehman Brothers collapses. The global financial system freezes. The S&P 500 loses 57% of its value. Real estate prices in Nevada and Florida collapse by 60%. The clients who kept their money with that banker didn't just preserve their wealth. While the rest of the world was panic selling assets at fire sale prices, his clients had the liquidity to buy the entire market for pennies on the dollar. This wasn't luck. This wasn't insider trading. This was the 18-month signal. It is a specific pattern that appears in the flow of capital roughly 18 to 24 months before a major liquidity event. It has appeared before the crash of 1929, before the dot-com burst of 2000, before the financial crisis of 2008. And the forensic data from 2024 and 2025 suggests the signal is flashing right now. In this video, we are performing an autopsy on the wealth transfer mechanism that separates the prepared from the wiped out. We will look at the 5 assets that appear on the 1% playbook when the liquidity trap snaps shut. Part 1. The liquidity trap. To understand why the wealthy position this way, you have to stop looking at prices and start looking at liquidity. In a stable economy, liquidity is abundant. You can sell a house in 30 days. You can sell a bond in seconds. You can get a loan against your portfolio instantly. But a crash is not primarily a drop in asset prices. A crash is a liquidity freeze. When the liquidity vanishes, the hierarchy of value inverts instantly. In 2007, the Knight Frank Wealth Report documented a shift that mainstream media missed. Ultra-high net worth individuals globally increased their cash and cash equivalents from 8% to 23% of total portfolios. At the same time, retail investors were being told by financial advisors to stay the course. The wealthy were not reacting to the news. They were reading the bond market. The mechanism is brutal and simple. When the yield curve inverts, meaning short-term interest rates are higher than long-term rates, it signals that the smart money is parking capital in safety. They are willing to accept lower returns in exchange for the ability to exit at any moment. But here is the part nobody tells you. Cash is not a store of value during a crash. Cash is an option. It is an option to buy productive assets when they are trading at distressed prices. The wealthy do not hold cash because they think the dollar will go up. They hold cash because they know that when the crash comes, the price of everything else will go down faster than the currency devalues. Let's move to the second asset on the list. This is the one that transfers the most wealth during a crisis, and it is almost entirely inaccessible to the average investor due to regulatory barriers. Distressed debt. Here is the mechanic. When a company approaches bankruptcy, its publicly traded bonds crater. A bond issued at 100 cents on the dollar might trade at 15 cents. The market panics. Retail investors flee. The financial media writes obituaries for the company. This is precisely when the sophisticated money arrives. Howard Marks of Oaktree Capital built one of the largest alternative asset management firms in history on this exact thesis. His October 2008 memo to clients is now studied in graduate finance programs. His core argument: distressed debt is not a gamble on whether a company survives. It is a legal mechanism for taking ownership of a company's assets at a fraction of their replacement cost. Here is how the machinery works. When a company enters bankruptcy, there is a waterfall of creditors. Senior secured debt holders sit at the top, junior bondholders below them. Equity holders, ordinary shareholders, occupy the bottom rung and typically receive zero. The bankruptcy court restructures the company. The old equity is wiped out entirely. The bondholders who purchased distressed debt at 15 cents on the dollar receive new equity shares in the reorganized entity. They did not buy stock, they bought debt. They emerged as the new owners. During the 2008 crisis, this mechanism played out at scale. Distressed debt funds purchased the obligations of automotive suppliers, commercial real estate trusts, and retail conglomerates that the market had written off as corpses. General Growth Properties, at the time, the second largest mall operator in the U.S., filed for bankruptcy in 2009. Its debt traded for pennies. Brookfield Asset Management accumulated significant positions in that distressed paper. When GGP emerged from bankruptcy, Brookfield held a controlling equity stake in a company managing over 200 shopping malls worth billions. The total cost of entry? Distressed bonds purchased at a fraction of face value. This is how wealth is legally transferred from the middle class, who held the equity and got wiped out, to the ultra-wealthy, who bought the debt and took the assets. Part 3. The Productive Land Hedge. Asset number 3. This is the oldest asset in the book. Productive agricultural land. The Knight Frank Farmland Index has tracked this asset class for over a decade. Between 2000 and 2020, prime farmland in the United States appreciated by over 500%. It did not crater during the dot-com collapse. It did not buckle during the 2008 financial crisis. Why? Because land that produces food has a floor built into its value that no other asset class possesses. That floor is called caloric necessity. Human beings require calories to sustain biological function, regardless of whether a central bank has mispriced risk or a leveraged financial institution has become insolvent. In 2023, reporting confirmed that Bill Gates had accumulated approximately 270,000 acres of American farmland across 18 states. Mainstream media framed this as an eccentric billionaire hobby. The financial logic is neither eccentric nor conspiratorial. It is ancient. In the Roman agricultural economy of the 1st century BC, the patrician class systematically accumulated public land during periods of debt crisis. As small farmers defaulted on obligations they could not service, the massive estates owned by the senatorial class expanded. The same pattern appeared in post-Black Death Europe. In post-WWI Germany, as the mark hyperinflated into worthlessness, foreign speculators and domestic industrialists holding hard currency purchased farmland from middle-class families who could no longer pay mortgages in real terms. Identical mechanism. Different centuries. Land that feeds people retains its value when the paper used to measure that value disintegrates. Asset number 4. This is the one that makes people uncomfortable because it is so unglamorous. Essential service monopolies. After every major economic crisis in the 20th and 21st centuries, the forensic record of private equity acquisition data shows a behavioral pattern so consistent it borders on algorithmic. In the 12 to 36 months following a major market dislocation, sophisticated capital systematically targets businesses operating in sectors with inelastic demand. Waste management, self-storage, funeral services, pest control, water infrastructure. These businesses share a single property that sounds unremarkable until you say it plainly. People cannot stop using their services regardless of economic conditions. A family that has lost its income still generates garbage. It still requires a storage unit when it downsizes from a house it can no longer afford. It still needs pest control when the infestation doesn't consult unemployment statistics before arriving. Death, particularly during crisis, operates entirely independent of central bank policy. The economic profile of these businesses under distress is almost perverse in its advantage to the acquirer. During a downturn, their revenues remain stable. Their labor costs fall as unemployment eliminates workers' negotiating leverage. Their competitors, often smaller operators using leverage to finance expansion, default on debt and go under. The acquiring entity purchases routes, contracts, client lists, and equipment at liquidation prices from operators who can no longer service their obligations. Wayne Huizenga built waste management into a national giant not during an economic boom, but by acquiring small regional operators during the stagflationary recession of the mid-1970s. No innovation required, no disruption thesis, no technology edge. Garbage trucks drive the same route whether the economy is growing at 4% or contracting at 4%. PitchBook data on private market transactions documents the pattern repeating in every cycle. Between 2009 and 2012, acquisition of essential service businesses by institutional private equity accelerated by over 40% compared to pre-crisis levels. The businesses that retail investors ignore during boom times become the highest return acquisition targets during bust times for precisely that reason. They were undervalued in the good times, and they became dirt cheap in the bad times, and their cash flows never stopped. Part 5. The signal is flashing. So here is what you actually absorbed in this video, and it is larger than the 5 assets. Every economic crash in modern history has not been a random natural disaster. It has been a predictable cyclical redistribution event. Capital flows from the unprepared to the prepared, from the panicked to the patient, from the passive holder to the structurally positioned acquirer. The middle class was taught that crashes are things that happen to them. The data from SEC filings, Knight Frank, and a century of private acquisition records tells a different story. Crashes are scheduled shopping events for people who know what they are buying, why they are buying it, and what price they are willing to pay. The financial system never hid this through malice. It obscured it through the assumption that this information is only actionable for people already holding access to these vehicles. That assumption is false. The principles are not vehicle-specific. Cash is ammunition. Essential businesses are permanent cash flow. Agricultural land is a caloric claim on the future. Distressed debt is an ownership mechanism in disguise. None of this requires a prime brokerage account to understand. What it requires is the willingness to look at what people building generational wealth are actually doing, not what they are saying at Davos, not what they are publishing in op-eds, and to sit with one uncomfortable question. If the next crash has already begun, casting its shadow forward into the present, measured in the T-bill accumulations, the private art deals, the quiet farmland acquisitions, the distressed debt positions being built by people whose entire professional lives are organized around this single recurring event. Where do you want to be standing when it arrives? Subscribe if you want to keep asking better questions.